In this episode, we'll interview Einar Vollset, the founder of TinySeed, a big and well-known B2B SaaS accelerator, especially for bootstrap founders. And he's also the founder of Discretion Capital, a really amazing M&A boutique for SaaS founders with 1 to 10 million in ARR. My name is Alexei and I help B2B SaaS founders scale. Now, on this episode, I'm super privileged to have Einar because he's not on every podcast out there. So it's a super unique opportunity. And TinySeed also owns MicroConf, which is the largest community for B2B bootstrapped founders out there. And obviously having so much data, one of the points we'll discuss is why did he launch TinySeed instead of a venture studio, for example? And then finally, one of the other topics we talk about is how SaaS is performing this year versus the last few years and how valuations are different from private equity and strategics this year, for example, compared to the last few years. So enough of me rambling, let's dive into the episode. Hi Einar, how's it going?
It's going well, thanks for having me.
Yeah, awesome to have you here. Cool, so in terms of introduction, you are originally from Norway, then did your PhD in computer science at Newcastle University in the UK, and then you were one of the OGs in 2009 going through YC, and then shortly after, less than a year, exiting your first business. Then, after a period of other businesses, exiting your second business, and then creating Discretion Capital, an M&A boutique, and then shortly after, pretty much, launching TinySeed, which is one of the best B2B SaaS accelerators out there and has also 2 funds already, and you're about to raise a 3rd fund, right?
Yeah, that sounds right. I mean, you summed up the last 25 years of my life pretty well.
Amazing. Cool. So for the viewers, obviously, let's dive a bit deeper into the details. How was it to be an OG in YC? Was it already that big back then? Can you describe how it kind of worked back then?
Sure. I mean, it was very different. Well, so I don't really know what it's like now because it's been such a long time, more than a decade. But certainly, it's very, from when I talk to other people about what it's like now, certainly what it was like in the last few years when there was 500 companies per batch, whatever. When I was going through, I think it was something on the order of 15, somewhere between 15 and 20 companies. It was still sort of in this warehouse that was mostly owned by, I forget who owns it, but it wasn't YC's own building, I don't think, even at the time. Paul Graham, PG, was still the one making chili. Jessica would be there. Jessica was actually, I think Jessica was pregnant with her first kid the year that we went through. And it was a great experience for me, partly because, I came from academia. So like you said, I got my PhD in the UK, but the reason I moved to the US is because I was a visiting professor at Cornell in computer science for a couple of years. And it was at Cornell I realized okay, academia is really not for me. It doesn't fit my personality very well. And then I left and really it was being part of YC that sort of gave me this instant network in the Silicon Valley. So for me, it was extremely helpful. It remains and is one of my main networks still, is sort of Y Combinator. And obviously now it's thousands and thousands of alumni, which is an extremely powerful network to be part of for sure. I think that's a large part of why people do it. And it was great. I mean, I have a lot of love for YC. I actually dodged the wealth bullet by not, because I did in my batch was the same batch as Airbnb. And I turned down becoming employee number 1 at Airbnb because I was working on my own thing. So it was great for me. I mean, we started TinySeed, and it's sort of it's a different path than YC, but I still have a lot of love for YC. It's just it's a different path. The way that I think about it, if you're going to go into YC, then really your goal should be to IPO, to really go for a massive outcome. That's sort of what they're optimizing for. And what we realized, and really the reason why we started, we started TinySeed almost a decade after I went through, was that, we wanted to explore whether there was a different path where it was okay, the outcome isn't necessarily IPO, it's this other path. And so that's how we ended up starting TinySeed.
Yeah. And yeah, TinySeed is definitely a big differentiation, and different value proposition than basically 99% of the accelerators out there, right?
Right.
It's a very nice kind of like, hey, if you're a bootstrapper and you might not necessarily want to, IPO or grow at all cost, come to TinySeed, and it's very cool. Yeah, so before, I guess, jumping into TinySeed and, maybe listening also how that evolved and why you decided to also raise funds for that. Why did you, after successfully exiting your first startup in software, decide to do an M&A boutique called Discretion Capital?
Yeah, so it was sort of up and down. So you have to understand, like my exit to Google, like this was 2010, and so when I did YC, there's another point about I was talking to a friend of mine who's a VC still and was a VC in 2009, and he remembers going to our demo day in winter 2009, and he was telling me, this is only like a couple of years ago. He said, at the time, the big question was if anyone was ever going to even write a single check. Because this was after the 2008 crash, and so things were very different.
Oh yeah.
So our acquisition, or the acquisition of my company, was mostly an acqui-hire of my co-founder. So I didn't make a ton of money, even at the time. A is an acqui-hire, which doesn't make a ton of money, and B, it was mostly an acqui-hire of my co-founder. So he sort of moved into Google, versus I didn't. And so really, what happened after that, I was like just bumming around, and we worked on the iPhone. We built an iPhone app for as part of YC, and so I ended up doing a bunch of iPhone consulting, mostly doing prototypes for other YC companies and other startups with money. I got really, really sick of that, and then so basically ended up building App Aftercare, which was a app maintenance service. So we basically charge you $1,500 a month, companies $1,500 a month to look after their instrument and look after their iPhone apps for them. And then I sold that in 2016-ish timeframe. And really, like, just sort of bummed around. I had, I wasn't making it didn't make a ton of money, but it was like I didn't have to really work for a while. And so really what happened was I was helping. So we just bought a place up in the mountains here, and I was helping my wife set up a flower farm up in the mountains. And then a buddy of mine from Chicago called and was like, hey, like, can you go to Florida next week? I was like, why would I want to go to Florida next week? He said, I'll pay you $20,000 for 3 days worth of work. I was like, great, I'll go to Florida next week. And it was basically doing just due diligence work for like old school private equity. So think, Chicago-based, East Coast-based, private equity buying, specialty distribution, specialty manufacturing, something like that. And they were doing tuck-ins for e-com and SaaS stuff, mostly e-com, to their existing businesses. And I was just doing DD work for them. Paid well, interesting people, whatever. And that was really my first, exposure to the finance world. Like I said, I have a PhD in computer science. I used to be a professor. Finance wasn't something that I was really into. And then actually, you get to know the private equity guys. And one time, actually, what happened was, I think we were at the bar, we're going for dinner or something like that. And one of the private equity guys was like, hey man, like, we pay for deal flow. And I was like, you just said words that I don't know what mean. What does that mean? And he was like, wow, like, if you make an introduction and like we buy the company, we'll give you a cut. And I did the math. I was like, wait a minute. So like an introduction, you're going to end up paying me like hundreds of thousands of dollars for an introduction? And he was like, yeah. I was like, okay. So I did that. So I did a couple of buy side deals. And really what happened was, this is right, 2016, 2017 timeframe. People started just reaching out. Like I said, I have two big networks. So it's like Microconf and so the Bootstrap software world and YC. And people obviously were getting, starting to get more and more inbound from private equity, software private equity looking to buy. But people didn't really know. It's a very opaque market. And so people didn't know, like, are these good buyers? Is this even a good price? I don't know. Like, so people just started reaching out. And I would give them my opinion. I'd be like, this is what I'm seeing in the market. This is a good offer. This is a kind of a terrible offer. Like, these are good buyers, or these guys are going to, they're going to fire everybody and outsource it and just milk it for cash flow. So one time I was telling this to one person. I was like, this is a terrible offer. This firm is famous for like firing all your domestic staff and just outsourcing it. So that's what they're going to do. And he was like, well, can you help me get a better offer then? And I was like, yeah, I think I can. So that's really how I started Discretion. It was really just me at the start. And again, with my technical background, I wasn't about to. I mean, I keep joking, like the only way I could get a job at an investment bank is if I started my own. So that's sort of what I did. And then I ended up basically being like, okay, well, I can't afford to hire like 4 MBAs out of Harvard to sit on PitchBook and look for deals and all that stuff. So I ended up building basically technical infrastructure to keep track of, who are all the buyers, software buyers in the world, what are their portfolios, who are the people involved in the various deals, so that what we're world class at, that like 1 to 10 million ARR still is placing, basically figuring out like where do you fit in to the portfolios of the larger private equity funds. That's 60-70% of our deals, because those guys, they pay strategic multiples or semi-strategic, in some cases better than strategics. So that's really how that started. Like I ended up doing, basically taking the technical approach. And I also found that a lot of founders, like they responded well to having a banker that, well, so first of all, like if you're dealing with the bigger banks, you're going to get some junior guy who's like 25, straight out of like an MBA program. It doesn't know any SaaS metrics at all. Versus like talking to me, people were like, oh, you actually know what you're talking about. Like you understand the metrics here and who the buyers are and all that stuff. So people responded well, and that's really how Discretion started.
Got it. That's a fascinating story. Yeah. I did a bit of the opposite. I went from being an investment banker to becoming a tech guy, right? So, yeah. But I think your order is maybe even better. So, oh, that's cool. That's cool. So yeah, and you're 100% right. Like, I mean, if you initially, you get to an investment bank, you talk to only the junior guys. And then until you like sign up the bank and start paying them a retainer, et cetera, that's when you start getting the attention of the MDs who still,
but not even that. Like honestly, like we compete. We compete on sort of two sides. So we compete on the lower end. We compete with the brokers that do everything. Like infra products, e-commerce, all this stuff. And like honestly, it's just a different game. So and on the higher end, we compete with the smaller boutiques. And like a lot of the time we win deals, because what ends up happening is, even if you're doing 5 or 8 or 10 million in ARR or whatever, the problem is like you might, when they're pitching you, like there'll be the 2 partners on the call and 3 associates and like 4 secretaries and all this shit until you sign. And then it turns out, you're getting the junior guy they just signed up last year, because, they're used to doing deals at 100, 500 million. That's what they want to do. Like obviously that's where the big money is. So nobody was really like fitting in that, like that 1, 2 to 10 million in ARR. Nobody was really doing a great job there. So like the market was right for somebody who knew what they were doing.
Yeah, and then obviously the industry focus allows you to be super hyper focused and know all the buyers out there, know all the transactions out there, and have like an amazing finger at the pulse. It's interesting how you started with buy side advisory and then moved to sell side. Usually the buy side is like so hard to get. That most people try to, start with sell side and then go to buy side in terms of mandates. But again, initially you had obviously the relationships and then, the network. So that's very cool. In terms of, I guess like sentiment out there, we obviously saw SaaS having a bit of a correction last year. And then, a lot of people are talking about like quite a good recovery already. The last 2 months. How do you see SaaS evolving this year, for example, compared to maybe last year?
So the way that we saw it was maybe a little differently than I guess a lot of others. So we really saw the collapse super early in 2022. That's really when the market sort of tanked for us. And really what was happening was the public markets crashed post Putin's invasion of Ukraine. And the really what happened in that 2 to 10 million range was that a lot of our buyers quickly sort of abandoned buying tuck-ins for their larger businesses, because the multiple compression was significantly higher at the larger stages. So if you were doing 50 or 100 million in ARR in 2022, public markets were trading at 4 to 6 times ARR. Your multiple compression was significant at that stage, because you're the larger company, you're closer to being public. the lower end, 2 to 10, was like, it was much more insulated from the public market turmoils. So a lot of our buyers moved up market and just said, we're not buying shit. We're just going to buy on the small side. We're just going to buy the bigger things. So for us, we, unlike you, I didn't have an investment banking background. So I didn't know you could take retainers. So we never took retainers. We still don't take retainers. We just do success fees. So I was like, oh, well, this blows. And then really what happened was, so like, because of that, our close rate, we're pretty picky about who we take on. Like, we don't just take anybody and then hang around. And, if we don't think we're going to get you multiple offers of where we think you'll transact, we just won't work with you. Like, it's just because it's a waste of our time. It's a waste of your time. And because of that, our close rate's quite high. It's like 75, 80% success rate from the mandates we take on. And so, but like in 2022, that went from like that kind of rate down to like 10%. Because all the buyers moved up market. So all the buyers were like, okay, we're going to start buying 50 million, 100 million ARR businesses that are in distress right before the public market. So that's what happened a lot in 2022. So 2022 was completely dead. And then 2023, it started to grow a little bit again, like things were going, but people were still far apart. So it was like in 2022, nothing got done, even almost at whatever price, because there was so much uncertainty. In 2023, at least in the early stages, there was some movement, but there was still like a pretty big divide between, founders still married to that, like, what can I get in 2021 type outcomes, and the private equity buyer or the software buyers who were like, well, it's a new dawn, baby. Like, you're not going to get that kind of thing. So it felt like through 2023, the market improved. Certainly it helped, that the S&P 500 or NASDAQ, whatever, came back. Multiples improved on the public markets. And so really, like, what we saw in 23 was the first half was still kind of rough. Like, it was slow. People were like, yeah, maybe, I don't know. but really in the fall last year, things started picking up again. And certainly I think, we're not seeing, so I think it's sort of become, at least it was late last year, it's become like a market of two parts. It's like in 2021, everything sold. Like, if you had a SaaS business above a certain rate, it didn't matter. Like, churn was high, that's okay, we can fix it. Like, growth is not that great, don't worry, we'll turn it around. Like, a lot of marginal businesses got sold. That was the time to sell a marginal SaaS business, was 2021. And then, and obviously the good assets were getting loads and loads and loads of offers. Like, at some point we had I think we had 22 LOIs for one of the processes we run, which is high, put it that way. I know. And then, but so in 2023, that's come back, but it is definitely like still a market of, like, if you have a marginal business, it's still hard. Like, the buyers aren't that interested in a marginal business anymore, but the good assets still are getting bids, and they're getting bids they're not getting as many bids as they were. They're not getting 22, but they might get 5 or 6. And like the highest value bids are about within range of where they were in like, wow, maybe not 21, but certainly in 20.
Mm-hmm, mm-hmm, mm-hmm. So in essence, the market is already expecting some sort of repricing, end of 2024 or 2025 to happen, basically, right? Like on the public market as well, if that's happening.
Yeah, I think at the lower end, I mean, like, you also have to understand, like, most of the well-paying people and stuff, like the target buyers for us, like, they own larger assets. So they're looking to do the classic buy and build, private equity play. So they might already have an asset. So for example, we sold one to, we closed on it last month, and we sold a tuck into Blackstone, and so, like, for them, they took C-Vent private. We helped them. We sold a tuck into them, and like, they just needed to win that deal because it made total sense for them, right? Mm-hmm. It wasn't like it wasn't a standalone thing that they then thought that, okay, the market multiples are going to expand so that in itself will go. Like, a lot of the stuff that we do still tends to be tuck-ins, because that's really, like, if you have an asset that's doing 2 to 10 million, mm-hmm, the people who will pay the post are either pure strategics, so Fortune 500s, or they're the larger private equity that have an asset where it makes sense to tuck you in. And that market is back for sure. What's not back quite yet, or it's back, but like certainly multiples are lower, are so the smaller private equity buyers who are like, buying it for themselves, like for their own platform. They want to buy something at 5 million and grow it. Like that still is hard. Although we're seeing a pickup on the growth equity side, where the minority buyers are coming in and still paying very good valuation. So my view of 24 is that things, as long as China doesn't invade Taiwan, I think we'll be in good shape.
Yeah. Interesting. And then, I mean, two other questions. One, do you only focus on US deals and also US buyers as a universe, or you probably still have like a decent network in the Nordics? Obviously, there are like there are tech companies coming out of the UK, continental Europe, a few as well. Do you do some work outside the US as well, or mostly US?
Yeah, we do. We certainly do. I actually don't have a great network in the Nordics, ironically, because I moved out of there straight after the army. So I was out of there by 19. So my network in the UK is actually stronger than it is in the Nordics. So yeah, we do mostly on the. I mean, we do all over. It sort of depends a little exactly on what makes sense, and I say that just because. And we talked to founders in TinySeed about this. Like the fact is, like most of the buyers are in the US. Like the most private equity buyers in particular, and strategics are in the US, and they actually don't care so much about where the team is based, but they do care a lot where the company is based. So like and there are probably half the buyers that we talk with don't have a mandate. Their LPs won't let them buy a company that is not North America based. And so what that means is that if you're European or Asian or South African or whatever, your buyer universe gets cut in half straight off the bat. And so that can be a challenge on the sell side. And honestly, like I still think, like to this day, I still think like a good strategy from the buy side is to go out and buy non-US assets. So go buy a Slovenian tech company or Swedish one or South African one, and flip it into a US corporation, and then you're almost guaranteed some arbitrage because just the buyer universe is just larger, So we do. I mean, I would say most of our stuff ends up being U.S. corporations, but certainly we've done with founders, at least founders in France, founders in South Africa, founders in the U.K., certainly founders in Holland or Netherlands. Trying to think where else. Germany? No, I don't think Germany. So yeah, no, we do all sorts, but it's mostly U.S. just because that's where most of the action is.
And then in terms of, let's say, the AI trend, right? Like obviously there's a saying, software eats the world, and then there's another saying, AI eats software. How is the sentiment, and what's the perception of some of the PE guys and some software strategics towards AI, right? Because you could argue that building a product will be easier in the future, and therefore marketing might be even more critical in the future to win the race, who will dominate a certain vertical, for example, in a SaaS category. So any kind of feedback there? What are the talks?
So I'm a huge AI bull. I think it's amazing technology. I actually almost did my PhD in AI. I think it's fantastic. That being said, like I think from the buy side, certainly the software private equity side, there's some wariness, just because there's a lot of froth in that market, even on the sort of bootstrap side. Like I was talking to one guy, and he came in and he's like, "Hey, I'm doing 4 million in ARR," and I was like, "Okay, perfect. Like I want to sell it." I was like, "Sweet, that's right in our sweet spot. Let's talk." I ended up not taking the mandate just because I didn't think that our buyers would be that interested, because it was a 9-month-old business and it was churning like 35% per month. It was growing like crazy, but people weren't sticking around. And so I think that's the challenge with a lot of the AI stuff that I'm seeing, is that tremendous growth, like absolutely bananas growth, but not sticky. So people are trying things out, doing a one-time thing, and then sort of being like, I don't know, like this is fine. Like, you still need to build like a business effectively to build a quote unquote easily sellable business, you still need to do the same thing. You need to build something that you're selling to businesses that people are using day to day to make money, to run their business. Like, and if your differentiating factor is AI, great. But like, certainly a lot of the AI stuff that I see tend to be less B2B and more like at best like B2 prosumer maybe, where it's like, okay, one time, maybe a little bit, but the underlying, if you look at the underlying SaaS metrics, it's still kind of super high churn, maybe fantastic growth, but very, very high churn. And like, there's one thing that I think, particularly like VC-backed startups don't understand, is like how sensitive to churn private equity buyers in particular are. Like it's one of the key metrics. Like you talk to some of these buyers, and they'll straight up tell you like, "Hey, I'm not allowed to buy my LPs to buy anything that's having like a net revenue retention sub, say 90%. They're just not allowed to. Like there's just not a thing. So if you're coming to me and you have an AI thing doing 4 million, but you're churning 30% of your customers or 50% of your revenue every month, I say that's great. And if you can find a buyer, that's amazing. And, or maybe, just work the cash flows for a while. It's a harder deal to sell just because the buyer universe just isn't there for those kind of assets in the same way.
Makes sense. So interesting point on the churn. I didn't actually know about how strict private equity is, on that point. And I thought maybe, they have some like interesting value creation going on to reduce the churn, and they see that as a big value maybe driver in the future. I spent a lot of time recently looking at various statistics. Obviously, there's like Nathan Latka doing kind of like a deep dive into what type of ACVs on average have companies who are 100 million plus ARR businesses. There's another exercise one of the partners at Point Nine, a German SaaS fund, did, where he also looked at, I think like 72 or something like that, public businesses, and counted how many of them have what kind of RPA, right? So average revenue per account, which is kind of like a proxy for ACV, I guess. So, and it's really interesting because in both, let's say, studies, the conclusion is that it's mostly deer hunters, elephant hunters, right? And, let's say, whale hunters, but like mostly elephant and deer hunters. And that's basically B2B high ticket, right? Is that something you also see basically also on the smaller kind of like deal size and revenue size?
Yes, I think so. I mean, okay. In terms of value, yeah, for sure. I mean, and I think, we see this and advise people on this on TinySeed's side as well. The fact of the matter is, if you're selling to an SMB market, you're going to have higher churn. People are going to stay a lot longer, a lot less. They're going to be more price sensitive. I mean, just there's just a natural churn in SMBs that's hard to overcome. Like, so I keep telling the story with Shopify. Like, if you look at Shopify's public statements, like they're churning at, I don't know, 5 or 10% per month, just as logo churn from their customers. And it's because, well, people think they're going to become millionaires. They sign up for Shopify. They think they're going to be millionaires drop shipping out of China, And they do that for a couple of months, realize they're not making any money, and they shut it down. There's nothing that the software can change to make that be different. And so that is the reality of a certain kind of client base. If you're taking $9 a month from people who think they're going to be millionaires drop shipping things from China, they're going to be disappointed, not because of your software, but just because of what they've chosen to do. And so the nature of SMB markets are such that that's kind of inevitable. And so if you have a SaaS that's sort of selling mostly to that's churning in that range, you basically need to do what Shopify has done. Like Shopify doesn't make most of its money from drop shippers. Like that's just not how it works. It almost has like a dual funnel where it's like, basically there's a bunch of people churning and trying a bunch of the small stuff, but they make most of their money from the larger accounts. If they didn't have like Shopify Plus or whatever it's called, where they're charging $2,000 a month plus to the larger businesses that are on their platform, Shopify wouldn't be worth what it is today. And I think that's true for a lot of SaaS companies. It's like you can get to a certain level But churn, particularly if your market and your offering is such that there's an inherent churn level there. In order to, like, you can get to 1 or 2 or 3 million maybe, but you're going to struggle to get to 10 or 15 or 20 without building out some sort of at least mid-market offering. If it's not true enterprise, certainly you need stickier customers paying you more. And to a large degree, that boils down to, like, are you creating enough value for these businesses that it makes sense that they can that you can charge them enough? That's what it boils down to.
Mm-hmm. Makes sense. Cool. And then, so let's spend a bit of time on TinySeed then. Obviously, TinySeed gives you interesting data. It gives you, interesting ideas. Obviously, also like deal pipeline in the future. Why did you, decide to do TinySeed in the first place?
Yeah, so what happened was, I started Discretion and realized pretty quickly that this is a pretty liquid market once you get past about $1 million in ARR, specifically for B2B SaaS. It's not true for other businesses in the same way, or business types in the same way, I don't think. But for B2B SaaS, it was. And really, like, what we observed was, like, at the time, and certainly I still think still true, like, you saw that, like, how to invest in startups, like, actually Sam Altman, he was a YC president at the time, he put a piece out that said, how to invest in startups. And one of his main pieces of advice was, like, don't ever invest in anything that can't be a $20 billion company. And, like, my observation was, like, that doesn't really make a ton of sense, because, that's great for that one path where it's like, grow as fast as you can and try to hit that. And that's the game. And my theory, and our theory, was that specifically for B2B SaaS, because it's so capital efficient, actually somebody should be backing companies where, like, the outcome, like a home run outcome, is selling for $100 million. And basically what it boils down to is, you got to come in at a reasonable valuation. You can't, there's too much dilution, so they can't be raising money every 18 months like your standard VC thing. But fundamentally, like, $100 million exit is much more common than an IPO. So there's many more of them than IPOs. And so that was the basis of it. It was like, okay, basically the way to think about TinySeed, it's like YC, but where YC puts you on sort of the VC track to IPO, TinySeed puts you sort of on the private equity track, if you will, to sell for, hopefully 50 or 100 or a couple of $100 million.
Yeah. I mean, when I was in private equity, right, like, the aggregate returns for the asset class of private equity were actually much better than the VC asset class, if you kind of, like, average out, 15 years of vintages. And that's basically because you never have zeros, right? Like, your worst performing asset might be like a 1.5 times money on money. And your best performing might be like 4 times, right? Versus in VC, still a lot of zeros. And then, yes, maybe luckily 100xer. But that's very rare if especially if you're not in Silicon Valley, for example, and don't have, like, the amazing deal flow. So it makes a lot of sense. I guess, like, having the deal flow, having the experience, being, a computer scientist yourself, etc. Why did you not do, for example, like a venture builder or like a venture studio focusing on, let's say, high ticket B2B SaaS businesses instead?
So I didn't, because we didn't want to run a giant company that was doing a bunch of different products, which is what, to me, venture studios smell like. Like, it's, I've seen them succeed, the venture studios, the venture studio model. It seemed like a lot of work, and I also seen a lot of venture studios not succeed, for reasons that we don't need to get into. But I have my theories, and I think, like, the reason why we didn't do it is in part relating to what you're talking about. So fundamentally, if you're going to do venture, like, you still need to have, even though the private equity side, if you're going to do super early, like, it's hard to do like a private equity type downside protection. Like, it's not like private equity starts to get into 2 or 3 million. People are surprised at how serious DD is from private equity. If they've only ever done VC, like, it's like, oh, due diligence, here's the money. Whereas just private equity is like 3 months worth of time, right? And like a proctology exam. And really, like, for us, because we're super early, but at the earlier stages of B2B SaaS, we still need to rely on, like, a little bit of that power law, a little bit of that outlier. And, like, fundamentally, a big part of our thesis is you need to make enough bets. Like, because the more bets you make in a power law outcome, the better your expected outcome is. And so fundamentally, that's what we wanted to do. We wanted to back a lot of businesses. And we think the failure rate will be significantly, and so far it is, significantly lower than VC. but we still need to make enough bets so that that 50 million, that 100 million, that $200 million outcome, we're more likely to get those. And like, we've invested in over 150 SaaS companies in the last few years. And like, we couldn't do that in a venture studio model. It's just not possible.
Makes sense. And then having a fund as part of your TinySeed accelerator, do you invest in all of the companies finishing a cohort, or are you selective? Because obviously if you don't, then that's already a bad signal for anybody who would, invest if you don't invest in one of the, your own.
So before I started an accelerator, I didn't realize that people would like run an accelerator and not put any money into all the companies. That to me seems completely insane. And I still think that's completely insane. And so, yeah, I mean, our fund, and there was some other guy who was confused about this. I'm like, no, like it's an accelerator, but it's a fund. It's the same thing. Like we use the funds to invest in every company that comes into the accelerator. That's part of the game. So everybody gets an investment if they're part of TinySeed.
Okay. Yeah. So you're the exception. Yeah. You might have been confused, but then, the normal accelerators actually don't have a fund until, recently, maybe last 4 or 5 years. And then, B, are quite picky where they invest. Very cool. So in terms of maybe, coming to an end here, what are the critical lessons you could share with SaaS founders out there?
Critical lessons. I mean, there's so much stuff, but I think like crucially, like you have to figure out how to make enough money from the people that you're providing the most value from. That's the sort of the alpha and omega for a sustainable business. Like you're not going to make up in volume if you don't have people that are willing to pay you a significant amount of money and keep paying you a significant amount of money for an extended period of time. Like if you're not creating enough value for your best customers that you can do that, you're just not, you're going to stall out at some point, probably before you like.
Would you also agree that the number of bootstrap founders and founders who want to only raise at a much later stage than before will increase?
Yes. I mean, I think like really like it comes back to the AI thing. Like I think the AI stuff is really hard to predict. Like what's going to happen? Certainly it feels like since we started, which is now half a decade ago, which makes me feel old, but like certainly like the indie hacker thing has just gotten stronger and stronger and stronger. I will say that like some of the indie hacker stuff is starting to get a bit like I'm starting to get like drop shipping, in the 2000s, 2010 vibes here. People are just like, I'm just going to do this. Like, it's just me. I'm never going to hire anybody. AI is going to mean I'm going to be $1 billion business by myself. And I'm looking at their underlying business and it's like, yeah, but you're churning 25% per month and you're charging $9 a month. Like just, there isn't enough people in the universe to actually have that happen. So yeah, that's what it boils down to for me.
I know. Amazing. Look, it's been super interesting. Thank you so much for your time. And hope to see you in Atlanta in April.
Yeah, absolutely. Look forward to it. Thanks for having me.
Thanks for sticking around. If you want to see the show notes, please go to neoptima.com/SaaS podcast. Otherwise, see you at the next episode. Bye.